Hey there, my name's Hugh and welcome to another video. In this video, I'm going to be talking about one of my favorite trading methods, hedging. Now, if you don't know what hedging is, I have a beginner's tutorial on hedging right there. You can watch that video and it'll get you up to speed. But in this video, I'm going to assume that you already know the basics of hedging, but you're not taking advantage of hedging as a trading method because you are believing some of the lies that are out there. So here are 10 straight up lies about hedging that you might read on the internet. Before I begin, remember that this is for educational purposes only and is not financial advice. Okay, number one, you can't be profitable because you make the same amount as you lose. So for example, you set a hedge where there's a buy and a sell, and no matter where the market goes, you're always going to have that loss in between. Now, I would say probably all of the people who make this statement assume that you're just going to keep that hedge in place and you're never going to move it, which makes zero sense, right? What you're doing when you create a hedge is you're limiting your risk. So you take a trade, you say, I'm wrong about the trade, so you hedge it, and then you find another trade or series of trades which creates profit that's bigger than this loss that you're carrying. So you take the smaller loss, you net it out against the bigger profit, and together they net out at a gain. For example, let's say that you think price is going to bounce off this support level here. So you're going to take a long trade if price hits that level like that. So you enter a buy there and then you wait to see what price does. So you wait and price goes down, down, down. Okay, so it looks like price might actually go in the opposite direction and you were wrong about this trade. So what you can do is hedge. You can put a sell in there at the same lot size. So at this point, you're 100% hedged and you don't have to worry about this too much because you can only lose the amount of that hedge. Now, the next goal is to go out and find another trade that will make up for this loss. So what you can do is you can just wait and see what price is going to do next. Now, it could be the case where this is a false breakout, right? Where price breaks out and it doesn't really go into a trend, it pops back. So if that's the case, let's see. Okay, so if price hits that level right here, then what you can do is buy. So let's see a more convincing break of that level. Okay, so that looks a little more convincing and it's likely that price might go up again. So I'm going to buy again there and then I'm going to wait to see what happens. And price looks pretty good right now because there's a pin bar there, right? So let's see what price does. Okay, so that level's holding. So there's really no need to hedge again because that level looks like it will hold. Okay, and price is going up, and now we're officially in profit. So we can close all of the trades at the same time. Now, this is just one example of an exit that you could do. There are 8 different exits that I use in my hedging, but that's just one simple example of how to get out of a hedge at a net profit. The second big hedging lie that you'll hear about is that hedging is illegal. There are only hedging rules in the US as far as I know of. Every other country doesn't have any hedging rules, so you're good if you're not in the US. If you are in the US, it is still possible to hedge, but you need to know some workarounds, and the workarounds are perfectly legal. But I have some videos that you can watch on hedging in a US account. So as this video is being made, it is perfectly legal to hedge in a US account. You just need to know the rules. And in other parts of the world, it is legal to hedge. There's no rules against it as far as I know. Things could change, so do your own homework on that. I'm not a lawyer. Number 3, hedging works the same in every single market, and that is simply not true. You can hedge in every single market, that is true. However, I would say that hedging is easiest to do in the Forex market. And the main reason is because transaction costs are relatively low in Forex, whereas in other markets, they're pretty high. For example, in the stock market, let's say that you bought some shares of a company and you want to hedge that with a put. So you're going to buy a put. Now, when you buy that put, the value of the put is always going to go down. So you're always going to have this smaller and smaller value on the put. And if you look into the statistics on options, you'll find that it's very, very likely that you're going to lose all of your investment in that put. So that makes it a very expensive way to hedge. You could also hedge in the stock market by shorting a stock. But when you short a stock in the stock market, you have to find somebody to borrow the stock from. So it's not as easy to hedge in the stock market as it is in the Forex market. And even with some markets like gold, silver, oil, you're going to be paying a lot on the rollover cost. And that's the interest to hold that position for one day. So if you do get stuck in a trade for a little while in those other markets, the interest cost can really add up and it can be more than the profit or loss on your trade. So that's why there's a huge advantage to hedging in Forex. And that's the reason why I only hedge in Forex. Next, a lot of trading coaches will teach that using a stop loss is the only way to be profitable in trading, and that is simply not true. In fact, a lot of professional traders don't use stop losses. In my research, when I was developing my hedging method, I found a guy who claimed that he would be profitable every single day and he would not use a stop loss. And the reason a lot of professionals don't use stop losses is because you can get spiked out of a trade. I'm sure you've seen some of those candles where there's a huge wick where price comes down and it immediately bounces back up again, right? So you don't want to be caught in that situation. You want to be able to stay in that trade until it goes, or if you're wrong, you want to be able to hedge it. Number 5, hedging will produce 100% winners, and that is a total myth and a total lie. Now, I mentioned that trader who said he had 100% winning days, and I believe that it's possible. I haven't checked it, but I believe that it's possible. However, he himself says that he does not have 100% winners. When he's wrong about a trade, he hedges it, and then he finds another trade to go and offset that loss at a net gain. So if you go into hedging expecting to have all wins, that is simply not possible. That is not how hedging works. And there will be some people out there on the internet who tell you to just take a trade, and then eventually that trade is guaranteed to get back into profit. So that's when you take your profits. And that's simply not true. That's a recipe for disaster. You always have to hedge or use a stop loss. And I find using a hedge is much more flexible. Number 6, a common myth is that hedging should be automated with a robot. And it's totally true that you can automate certain parts of any trading strategy with a robot. However, if you rely on a 100% automated robot, that's a recipe for disaster. The only time you should be using a fully automated robot is if you design it yourself and you know exactly how it works, and if that trading strategy matches your personality. Now, if you decide to buy a trading robot or use another person's trading robots, what if that person goes out of business, they stop trading, they don't want to support the robot anymore? Then you're back at ground zero with no trading skills, and you're going to have to learn all over again. That is why it's my strong belief that you need to learn how to hedge for yourself and not depend on a third-party robot to do everything for you. This is an interesting one that I came across recently, and somebody gave the advice, hedge your winners. And that makes zero sense. The biggest risk in hedging is going to be carrying too many open positions. So in my method of hedging, I try to get to flat as soon as possible. And in my research, I found that the hedgers who have failed over the years, who had big investors, who had big money, they failed because they were carrying too many open positions. So in hedging, if you have a winner and you want to take that money off the table, it's best to just close the trade, bank your profits, and look for the next trade. Now, if you do hedge a winner, you are probably going to be losing a little bit of money on the interest every day. So it makes no sense to hedge a winner. And if you are afraid of important news coming out and causing price spikes or volatility, then the best thing to do is just to close out your winner and wait for the news to come out, see what happens, and then put your trade back on. Number 8, never use a stop loss in hedging. And that is simply not true. There are times when stop losses are useful. I use it in a exit method that I call the waterfall exit. And that's the only time that I use stop losses, but they are very useful in that scenario. So never say never, and be open to using stop losses in hedging. Number 9, you need to know complex math to hedge, and a related one is I need a mathematical hedging formula. You don't need to know complex math to hedge profitably. You can just use support and resistance levels, or you can use an existing trading strategy and hedge out of it if you're wrong. Now, the people who say that they need a mathematical hedging formula or they need a robot are trying to eliminate uncertainty. And there's no such thing as eliminating uncertainty in trading. You get paid for dealing with uncertainty. But the great thing about hedging is that it gives you so many ways to deal with uncertainty, and it's very flexible, and it's not as rigid as other trading methods. And the last myth I want to talk about is that hedging is a martingale strategy. And there are 2 reasons why people think that it's a martingale strategy. Number 1, in that first example, I put on a buy, and then I put on a sell, and then I put another buy on, and people think that you're just going to keep repeating that process, buy, sell, buy, sell, buy, sell, and that's simply not true. You're just going to put on hedges, and you're going to figure out ways to roll off those hedges. So it's not a martingale strategy. And there was a hedging strategy going around on YouTube where you keep buying bigger sizes as price bounces back and forth, and that might seem like a martingale strategy, but when you really look at it, it's not. But it is very risky, and you really have to understand the risk parameters, so I would not recommend most people trading that way. So those are 10 myths and straight up lies about hedging. As I always say, think for yourself and do your own research, figure out what works for you. And if you're interested in learning how to hedge in Forex, you can take my Zen 8 Forex Hedging program, and that will teach you everything I know about hedging. All right, if you like this video, give it a thumbs up, subscribe and hit the bell if you want to get more hedging videos. Thanks for watching, and see you in the next video.